This video is a must-watch for all business owners. I'm going to cover something that very few entrepreneurs understand. I'm going to teach you about the two most important financial reports you need to be able to produce for your business at all times. But not only am I going to teach you about them in a very easy to understand way, I'm also going to show you why you must have your tax strategies baked into these financial statements ahead of time, instead of trying to find tax deductions and implement tax strategies after the year is over when you're preparing your tax returns, because by then it's just too late. Now, if you're someone who's just keeping track of your expenses on a spreadsheet, or even worse, just adding up your expenses and providing them to your tax preparer at the end of the year, you're putting yourself at a massive disadvantage compared to someone whose tax strategies are already built into their financial statements. Don't worry, I'll unpack that here in a second. The two reports are called the profit and loss statement and the balance sheet. And while you may have heard of them before, it's likely that no one has ever explained them in the manner in which I am. But before we dive into them together, let me quickly introduce myself if it's your first time watching. My name is Navi Miraj. I'm a certified public accountant who teaches entrepreneurs how to save thousands of dollars in taxes. I do that by providing free content right here on social media, but I also do it through a comprehensive course, which is designed to convert business owners from knowing nothing about taxes and teaching them how to become tax-savvy entrepreneurs who implement tax strategies that save them thousands of dollars each and every year. If you're interested in learning more, you can click on the link within the description below or visit my website, which is navimirajcpa.com. Okay, let's jump into these reports. So the first report I'm going to cover is the profit and loss statement. This report shows you the revenue, expenses, and the resulting net income which has occurred for the accounting period shown in the heading of the report. So I've got an example here. Let me walk through it. In our example, we've got a profit and loss statement for sample company, and this is for the entire year of 2023. Now hang with me, because in a moment I'm going to explain how I've got $17,686.53 in tax savings baked right into these financial statements. But first, I just want to show you how this profit and loss statement works to make sure you understand. So we've got revenue of $150,000. You might generate the revenue in your business from providing a service or selling products, or maybe you even do both. Now below the revenue, we've got our expenses, okay? We've got basic expenses such as $12,000 for advertising expenses for this particular business. But literally, every other expense that I show you on this profit and loss statement involves a tax strategy. You see the mileage reimbursement here? This is the deduction received related to the miles they've driven their vehicle for business. Now in this particular example, we're using the mileage method, but if this person wanted to buy a heavy vehicle over 6,000 pounds, we would be able to write off the majority of the vehicle cost within the first year of placing the vehicle into service. Okay, now next we have legal and professional fees of $499. Now this happens to be the cost of the course at the time of recording this video, and in order to receive the course for this price, you'll need to just grab a coupon code which you can receive by entering your email on the course overview page. But next here we have management service fee of $9,850. This relates to paying this taxpayer's children out of the business for providing services to the business. Now, this business is taxed as an S corporation, so I'm teaching you how to do this in a way that avoids paying FICA taxes by not paying the children directly out of the S corporation, and we'll use a management company to do that, okay? We've got meal expenses here, but there are opportunities in 2024 to still receive a 100% tax deduction for your meals instead of 50%, which again, that extra 50% to bring you to 100 is taught in the course. Normally people would deduct just 50% for meals. Next, we have something called office occupancy expense. That's a deduction for using a portion of their home for business, okay? Further below that, we have officer compensation of $40,000. Now, by having this business taxed as an S corporation and paying the officer a reasonable compensation of $40,000, we are saving this owner of this business about $7,000 in FICA taxes. If you haven't heard of that term, FICA taxes is primarily Social Security and Medicare taxes. Not only that, but we're incorporating the cost of their health insurance premiums, so there's an additional $1,530 in FICA tax savings, again, baked right into these financials. Below that, we have $10,000 in pension and profit sharing plans. Now, basically what this is we have a $10,000 match to the employee's 401k. The $1,875 in travel is for having a board of directors meeting that included the business owner's spouse and teenage children, as they too are involved in the business. And the remaining expenses related to internet connectivity and required communications are the business owner's cell phone and home internet expenses, which leave us with a profit or net income of $60,000. Okay, you see it's $59,999.88, but there's some interest that was earned, so it's $60,000 total. Okay, so if you're adding that all up, there were $36,626.12 in tax strategies already built into the profit and loss statement. Assuming a very reasonable 25% income tax rate for federal and state income taxes, that's $9,156.53 in tax savings. Okay, now if this student was in a 40% combined tax bracket, the tax savings would equate to $14,650.45. Now, that is just the income tax savings. There's also Social Security and Medicare tax savings built right into these financial statements, and the student's overall tax structure that's saving them an additional $8,530 in taxes. So if you add both of these together, that's $17,686.53 with a 25% income tax rate and $23,180.45 with a 40% tax rate. These tax savings were all baked in and occurring throughout the year while the business owner was running their business. The business owner can simply print off these financial statements, hand them to their tax preparer as is, and receive those tax savings, okay? So it's pretty powerful stuff. Now let's move on to the balance sheet, okay? Let me click over here. The balance sheet reports a company's assets, liabilities, and equity at a point in time. In this case, that point in time is December 31st, 2023, the last day of the year. Now we have a total of $66,000 in assets. That is the amount of the money in the business checking account and business savings account of this business. We have a liability of $10,000 as of 12/31/2023. This liability is for the employer match of the employee's 401k. See, we haven't even paid that out yet. It's a liability, yet we're receiving a $10,000 tax deduction for it in the tax year of 2023. Now let's move on to the equity section. Now this section confuses a lot of entrepreneurs, so let me explain what's going on here, okay? We have an account named capital stock. This is the initial investment the business owner made into the business when they first started it. I'm going to skip retained earnings and come back to it in just a moment. We then have a shareholder contribution account. Some accountants may call this additional paid-in capital, or APIC for short. This account represents the additional capital the business owner deposited into the account over and above that initial investment. So what we're saying is that the business owner deposited $5,000 in cash in addition to the $1,000 they deposited when they first started the business. Okay, now let's go back to retained earnings. Retained earnings is exactly what it sounds like. This amount, the $10,000, represents the amount of profit the business made in prior years that the business owner did not distribute to themselves. They retained those earnings in the business. So in our example, we're saying in 2022 or perhaps a prior year, there was $10,000 in profit that was not distributed to the business owner. If that's confusing, I'm going to explain that again in a second. Next, we have the shareholder distribution account with a balance of $20,000. Notice this number is negative, which means it is reducing the equity of the business. The distribution is the amount of money the business owner took as a distribution from the $60,000 in net income it earned during 2023. And this is done by simply transferring money from the business checking account into the personal checking account of the business owner. Now, I alluded to the net income number of $60,000 a moment ago. That number should look familiar. It's the $60,000 from the profit and loss statement, remember? Let me quickly just show you that in case you forgot. We have the $60,000 in net income here on the profit and loss statement, which is the same $60,000 that you see here in the equity section of the balance sheet, okay? So let's now sort of add up our equity accounts. We have capital stock of 1,000, retained earnings of 10,000, $5,000 in shareholder contributions, $20,000 in shareholder distributions, which reduced equity, and $60,000 in net income. This brings our total equity to $56,000 as of December 31st, 2023. Now, there is something called the accounting equation, which is assets equal liabilities plus equity. So you can see here that $66,000, our assets, okay, equal our liabilities, which is $10,000, plus our equity of $56,000. In other words, $66,000 in assets equals $66,000 over here in our liabilities and equity. So our balance sheet balances, okay? If your balance sheet doesn't balance, you have a problem. Now, I want to show you something that trips up a lot of people. If I go to the very next day in my profit and loss statement, which is January 1st, 2024, my profit and loss statement is blank because it restarts each year from zero. I haven't had any income or expenses yet in 2024. And yes, if you're wondering, I'm actually recording this video on New Year's Day. Now, if I look at the balance sheet, these balances don't restart from $0 on January 1st, 2024. I still have $66,000 in the bank. I still owe the $10,000 to the 401k administrator for the employer match, but my equity account did change a little, okay? Automatically, the $60,000 in net income from 2023 is rolled into the retained earnings account, making the total retained earnings $70,000. But I did take a $20,000 distribution, right? I took that $20,000 in the prior year. So what you need to do is you can handle this in a couple different ways. You can just remember to add the retained earnings balance to the shareholder distribution balance to reflect your true retained earnings, which is actually $50,000. Or you could record a journal entry. The journal entry would be a debit of $20,000 to retained earnings and a $20,000 credit to shareholder distribution account. This would give us a retained earnings balance of $50,000 on January 1st, 2024, which in my opinion is more representative as to what actually occurred. Let me show you what that would look like if we recorded that journal entry. So just give me 1 second to do that. Okay, so I just recorded that journal entry, and now you'll see that the balance sheet looks a lot cleaner on January 1st, 2024. Okay, the return earnings is $50,000, and our shareholder distribution account is $0. Because in my opinion, as of January 1st, 2024, we haven't taken any distributions, okay? And that previous figure of $70,000 was not our retained earnings anymore. So now that's been consolidated. You might hear accountants refer to that as closing out shareholder distributions into the retained earnings account, okay? So if you're watching this video and a light bulb or two turned on for you while you're watching, I encourage you to click on the link in the description below or visit my website, which is navimuradcp.com, to learn even more about the course. I just had a little bit of time with you in this video, but in the course, I unpack all of the tax strategies I mentioned today, and I actually teach you what they are and how to implement them right inside of QuickBooks. I even created modules called Building the Foundation, so you'll understand all of the terms I was using in this video. I encourage you to join Melissa, whose savings will be $11,000 per year, or maybe Sean, who will be saving $6,021 per year, or even Moise, who just started his business and will be saving $4,000 annually. If that sounds like something you want to be a part of, then I'll see you in the course. If not, I hope you received value out of this video, and I encourage you to subscribe to learn more in my next video. I'm going to link a video at the end of this one that explains how S-Corp taxes work and walks you through a tax return. So I recommend watching that video next.